Aaron, what is private equity?
So private equity, in its most simplistic terms, is simply the investment in private businesses. Because that is such a wide category of investment, it's important to sort of narrow that down in understanding and realize that you're involved in a very complex investment universe when you engage in private equity. There's about 10 times more privately owned large businesses in the United States than there are publicly traded companies. So if we only invest in publicly traded stocks, then we're missing out on a huge set of opportunities. The range of businesses that could be included in private equity are really everything from the $25 million industrial business all the way up to multi-billion-dollar infrastructure opportunities. And so it's important to go further when you're defining private equity, or if somebody's talking about private equity, to really drill down and understand, well, what type of private equity are we discussing here?
And how does private equity compare to publicly traded companies?
So the stock market is an excellent price discovery mechanism. There's many parties that are involved in looking at a price, and it's essentially an auction mechanism to create that price discovery so you have an accurate reflection of value. In the private markets, you don't have that. There's fewer data points available to look to understand the value of a business. There's fewer participants that are pursuing those opportunities, and those participants have sort of a different range of motivations as to why they may participate in owning that particular investment. So the opportunity for greater alpha is higher. There's a much higher likelihood that there's an undiscovered investment opportunity in the private markets than there are in publicly traded stocks.
And how has private equity changed in recent years?
So historically, private equity has used the mechanism of a closed-end fund. And a closed-end fund, it was the realm of sort of the institutional level investors, foundations, pension funds, family offices, investment entities with large amounts of capital, with long time horizons that could accept low amounts of liquidity in their investment tools. And so the way a closed-end fund was structured is the investment manager would come, the private equity investment management manager would come to an investor and say, we need this amount of money, how much will you commit? You make the commitment. As they go out and make their investments, they call capital from you, and you make those investments. And then you wait quite a long time, sometimes more than 10 years, 15 years. And then you start to get your money back as those investments are sold and those gains are realized. That did not lend itself well to the wealth management space or the individual investor, because individual investors don't always know when they'll need liquidity out of their investment pool. And so a recent innovation over the past decade or so has been the creation of open-ended evergreen private equity funds. And the way this works is you need to have a high frequency of deals coming in and out of the investment tool in order to ensure that as certain investors require liquidity, you can provide that for them, because there are just naturally investments leaving the fund and there's investments coming in, so you can balance that capital flow more accurately. The requirement of higher frequency of deals, though, means that only the largest private equity investment managers have that frequency or range of opportunities to facilitate that open-ended private equity structure. And so it's important to understand that those are the parties you're dealing with when engaging in an open-ended fund.
And how can investors access private equity And how does it fit in an investment portfolio?
So it's important to understand the players you're working with, because the skill set of the investment manager, their networks of information, their networks of opportunity play a much larger role in whether or not that particular fund will be able to capture higher amounts of alpha. So it's important that when you're creating these investments that you deal with senior tier players, and you deal with a wealth management firm that's worked with that manager to sort of understand and effectively vet whether or not they're creating an edge or have some sort of a secret sauce in the way they're doing your investments. So that's a key piece. And also, you need to have a clear understanding of liquidity provisions and whether or not that's an appropriate risk to take in your portfolio.